The other type of short sale you might consider doing is called a HAFA short sale. HAFA stands for the Home Affordable Foreclosure Alternatives, and it's the government-sponsored deed in lieu and short sale program. HAFA is limited to the sale of the borrower's primary residence only, and for the most part, the home must be occupied at the time of the sale. The program was expanded to allow for the sale of certain vacant properties, as long as the reason for the borrower's relocation was related to their employment and the borrowers have not already purchased another primary residence. The other HAFA eligibility requirements are in part as follows. The borrower must sign an affidavit which states they do not have enough liquid assets to be able to afford to make their mortgage payments, or they've experienced some other non-economic qualifying hardship, such as job relocation, divorce, or medical condition, which makes continuing to pay their mortgage unreasonable or unaffordable. HAFA also allows the borrower to receive a pre-approved short sale, which includes the minimum acceptable net proceeds the lender must receive so the seller can know up front what the home must be sold for to be approved. One of the other benefits of the HAFA program is that it also requires the borrowers to be fully released from future liability for the first mortgage or any deficiency judgment. Second mortgage providers must also agree to release the entire mortgage deficiency for the short sale to qualify for HAFA. However, junior lien holders cannot accept payment in excess of $6,000, and they are not under any legal obligation to grant the waiver of deficiency. So, that means that if your second mortgage won't agree to release you from all liability in exchange for $6,000, then you can't complete a HAFA short sale. You could still try and complete the short sale as a traditional short sale, however. If you are approved, the program also provides for an automatic deed in lieu after 120 days of listing if no approved offer is obtained. HAFA also provides the seller with some financial incentives, including most notably $3,000 payment at closing to cover the borrower's relocation and moving expenses. So who's participating in HAFA? Not all lenders and loan servicers are participating in the HAFA program, but most are. To find out if your mortgage is owned or serviced by a participating lender, click on the HAFA Participating Lenders list button below. If your lender or loan servicer is on that list, then more than likely your loan is eligible for consideration under the HAFA program. However, if your loan is an FHA, VA, or Ginnie Mae loan, it is likely not eligible for the HAFA program, even if your lender or servicer is on the participating lenders list. While FHA loans are not eligible for HAFA, FHA does have its own short sale and deed in lieu program called the FHA Pre-Foreclosure Program, which is very similar. If your lender or loan servicer is not on the list, you may still be eligible to apply for HAFA if your loan is owned by Freddie Mac or Fannie Mae. To find out if your loan is owned by either one, you can use the lookup tools by clicking on the appropriate buttons below. One final note. If you're confused about who owns your loan, or if it's eligible for the HAFA program, you can always just call your lender and ask. Some borrowers who have already fallen behind are scared to call their lenders, but you shouldn't be. Just keep your questions simple and your objectives clear. Remember, your loan servicer is required by law to tell you who owns your loan, and if you're eligible to apply for the HAFA program. You are also under no obligation to furnish the lender with personal financial information unless you want to volunteer it. Keep in mind, just because you're eligible to apply for the program, that doesn't necessarily mean you will get accepted for it. So, when does using the HAFA program make sense? Well, if you meet the eligibility criteria discussed, and you live in a state that provides that your lender may pursue you for the deficiency post-foreclosure, then doing a HAFA short sale is a true no-brainer. This is because the lender must agree to waive their right to pursue you for the deficiency as part of the short sale approval. In states that forbid the lender from pursuing the borrower for the deficiency, lenders are getting better about waiving that right to pursue them as a part of the short sale, even in non-HAFA traditional short sales, but it doesn't always happen. Therefore, HAFA can be a pretty good insurance policy to make sure that your lender waives the deficiency as a matter of course. One other added benefit of the program is that it forbids lenders from asking the borrower to contribute any money at closing, otherwise known as participating in the loss. They are also forbidden from asking the borrower to sign any new promissory note to repay any portion of the deficiency balance going forward. Both of these requests are common in the traditional short sale context. The other huge benefit of the HAFA program is that the first mortgage lien holder will pony up more money to give to the junior lien holders in exchange for release of the lien. Under the program, the first mortgage can give a junior lien up to $6,000 rather than the usual $3,000 given in a traditional short sale. Keep in mind, however, that this not only must junior lien holders release their lien on the property, they must also agree to waive their right to pursue the borrower for the deficiency of their loan as well. This, of course, sounds really good until you find out that they're under no legal obligation to agree to this condition. If they don't agree to waive their deficiency rights, then the transaction gets removed from the HAFA program and becomes a traditional short sale instead. HAFA works especially well when the first and second mortgages are owned, or at least serviced, by the same lender, because the second mortgage will be less likely to hold up a short sale, which has already been approved for HAFA by the same servicer or investor. If the first and second mortgages are owned or serviced by different lenders, it's not impossible to get a HAFA approval. It's just a little more difficult to get them to both agree to the terms of the loan. So, why would a junior lien holder agree to waive their rights under the HAFA program? Well, if the borrower truly doesn't have any assets in the first place, then the idea of receiving a higher payoff than they would via a traditional short sale starts to sound pretty good. Furthermore, if the borrower does not have significant assets, then giving up the right to pursue a borrower that can't afford to pay them back anyway is not really giving up all that much at all anyway. However, if a junior mortgage lien holder believes they have a good chance of recovering more than $6,000 from the borrowers based on their financial strength by reserving the right to pursue them post-foreclosure, then they may not agree to waive that right, and the short sale will not be able to close under the HAFA program. In that circumstance, a short seller can still move forward, however, it will close as a traditional short sale instead. Keep in mind that if the home you are trying to sell is not your primary residence, or you don't have any real documentable hardship, it's very unlikely that you will qualify for the HAFA program. If you do qualify, then applying for the HAFA program can make a lot of sense.